it's fair to say that FX markets have entered a period of summer doldrums. Volatility is near the lowest levels of the year, and that's not just in FX markets, it's also in interest rate markets and equity markets as well. So why is volatility so low? The answer there is probably a function of what's happening with central bank tightening cycles around the world. In many countries, central banks are close to the end of their tightening cycles. For example, the US Fed has recently raised rates to about 5.25%. We think that is the peak. Investors are expecting not much change in policy rates for probably the rest of this year, and that's feeding through into FX markets as well. So what does low volatility mean for FX markets? I think we've discussed this strategy here before, the idea of the carry trade, where investors borrow in a low yielding currency like the Japanese yen, and then invest those funds in a high yielding currency like the Hungarian forint, and the investors can pick up the carry or the extra yield. And that is reflected in the performance of these currencies so far this year. So now let's look at the path ahead for FX markets. And I think our core view would be that US disinflation will accelerate through the year, US activity will slow, Fed funds rate have peaked, and the Fed will be in a position to cut rates probably by March 2024. We think that will mean that the dollar will have to come lower across the board. And if we're right, we would expect the euro-dollar exchange rate to be somewhere near 1.15 by the end of this year.